There's two of you, Sophia and Marina. Thank you so much for coming. Let me just tell a little bit about me and then what you, as I said, and moved here recently from Boston. My husband and I have been teaching this material for 20 years, mostly in our churches on a faith-based curriculum, but we've also adapted it to being just normal, commonsensical things because the principles are all the same. And the other thing is, I was a stay-at-home mom. Then I worked for a British manufacturing company the last 13 years. I was executive assistant in a church and keeping the senior pastor and the executive pastor firmly in line. And then I retired recently. And I don't have a financial background. I am a total goofball when it comes to arithmetic. I do not trust myself. I use a calculator. Numbers are very scary. I understand the principles, and this is what I want to encourage you. You don't need a PhD in math. What you need is just understanding the principles and getting yourself a few strategies to make it work. So, Marina, I'm going to pick on you and just tell me just a little about yourself and what you are interested in, because with the two of you, we're just going to work on what you guys want to do.
All right. Well, I think I'm not a spender. I tend to be a saver, but I don't think I always understand the big picture. And so for that reason, I think I'm not always making good decisions. I also procrastinate. I got a late start with thinking in spreadsheet. So there's so many factors to consider. People think today in spreadsheet terms, and I am just now sort of learning to do that with my yearly spending and all that stuff. So just trying to make smarter decisions that keep the big picture
Great.
in mind.
How about you, Sophia?
Well, I've taken this class to better myself as far as financial terms and other things like that, because I didn't have a bank account until I started working. I wasn't one of those kids where your parents said one up for you when you were a little kid and kind of showed you how to do that. It was just kind of, I don't know, my family has a history of having bad credit for being in debt, just because they grew up in the time where college campuses, they have the credit card people giving out cards to everybody, and everybody's like, oh, sign up. They're like, yeah, don't do that. I'm like, that's also illegal now, so. But yeah, just trying to save up enough so I can pay for myself to go to school.
Okay. Now, there's some things that I want to learn, because I don't want to do stuff that will be too basic. Do you, know how to write a check, know how to balance a checkbook? So.
Know how to write a check. I don't think I necessarily know how to balance a
A
check.
checkbook. Okay, because that's great. So this is now because we have. I wanted to say, if you know how to write a check, and you've seen it before, so we don't even need to do that. So we just put that away. I never know with a group what I'm going to give you.
I guess people are writing, electronic checks and stuff, so.
Right, a lot of times now with electronic banking, they're not actually never writing a check. This is just my whole slide deck, and it'll just give you somewhere to write notes. I'm going to go, first of all, I just want to cover a couple of topics. So financial terms, financial accounts, credit supports, loans, and debt. So financial terms. So these are kind of terms that are there, and that's all in my presentation, so you can just see it in there. Assets, liabilities, net worth, income, expenses, cash flow, interest, and compound interest. Do you understand what all these terms mean, or would you like me to go through them? No problem. This is why we did this. So the first thing we're going to talk about is your net worth. So your net worth is your assets and your liability minus your liabilities. So here's a little basic. If you look at this goofy little sheet, you have two sides. you have on the left-hand side, what I owe, that would be your liabilities. And on your right-hand side is what you own, that is your assets. So to get a net worth statement, you write out all the amount of what you owe and everything what you own, you add it all up, and then total of all I own minus the total all I owe equals your net worth. So let's look here at Sandra. Okay, Sandra here has a description. She owes her mother for extra cell phone charges $250. That's a liability. The present value of a savings bond that her uncle gave her, that's an asset. Balance on a car loan, that's a liability. Savings account from a summer job, that's an asset. A DVD collection is worth $200, so we'll call it an asset. If she wanted to sell it or whatever to make some money, she probably wouldn't get that, but we know how that is. Yard sale, people aren't going to pay that much for that. A 1999 car, the value of that car is $3,500. This is dated, okay?
Yeah.
And balance due on the prom dress is $200. So if you split it out, you have her assets, which are $150 for the savings bond, for $750 for a summer job, $200 for the DVD and the car. Their total asset is $4,600. And on the liability, what she owes her mother, the balance and the balance due on the program is on the prom dress, $1,950. So Sandra's net worth is $4,600 minus $1,950, or $2,650. That's what you mean when you say a net worth. This is a very simple net worth statement, and if you wanted to figure out what your net worth is, I just gave you a little worksheet to work through. Does this make sense? Income and expenses, all right? What is income? What is income?
What you're bringing in as far as.
Which one is it, all right? Now, do you know the difference between gross income and net income?
Your gross income is what you're totally bringing in from working your hours, and the net income is what you actually get paid.
You got it. And then, how about, let's see, no, okay, I didn't, so let's go back to income. So gross income, as you said, now, Sophia, you're a barista. Do you have irregular income? Do you get a regular paycheck, or are you working on commission?
I have a regular paycheck, so we get paid bi-weekly, but then it's also slightly irregular for the fact that we just started doing tips. So.
Okay, so you might get, but you do have a regular paycheck that you can use. It's a whole lot easier managing with you have a regular paycheck as well, correct?
Mm-hmm.
Okay, so the gross income will be, when you're hired, this position pays $65,000 a year. That would be your gross. The net income, what gets taken out? The federal takes a little bit out, a lot out. The state takes some out. You get, if you have health insurance, that gets taken out. If you do a profit sharing or a 501k or 403c or whatever through your company, that gets taken out. So when we talk about net income, that's what you, as Sandra said, what you actually get to take home. And so that's the take home pay, and that's what, for your planning purposes, I hate to use the word budget, because budget is like diet, it's a wordy word. It makes you say, no, I can't. Why? We call it a spending plan, because with a spending plan, you are in control of how you spend your money. It's not the budget telling you what to do, you are in control. So I like to use the term spending plan. And you base your spending plan on your net income. So what you actually take home after everything is taken out. So fortunately, you're on a regular
Yeah.
Right.
Regulars.
Okay. So, expenses. What are expenses?
Going out for your living.
Everything, you know, everything is expense. Any money that you give out, that you pay out is an expense. You have fixed expenses. Can you think of things that would be a fixed expense? That you always pay the same amount every month?
I know for me personally, like my student loan payment is a fixed expense.
Your student loan payment is a fixed expense. What else would be a fixed expense, do you think?
Insurance.
Yeah, I'm thinking more along the line of your rent or your mortgage payment.
Mortgage or something.
Your
okay.
rent or your mortgage, it's always, you know, that amount due on a certain date. So I will totally date myself. We bought our very first house in 1974, and my mortgage payment was $177.88 per month, and that was a fixed expense. It was in 1974, 1,000 years ago. So that's a fixed expense. Variable expense are the ones that go up and down, in that groceries are pretty stable, but sometimes you buy more. Let's say you're having a party, so you buy more groceries, or all of a sudden you need clothes, and you don't buy clothes all the time every month. So sometimes you buy a lot of clothes, and sometimes you may go 2 or 3 weeks without buying clothes. So that is what we call a variable expense. It varies from month to month.
Okay.
And then you have quarterly or annual expenses. Sometimes some bills are paid once a quarter. I think taxes are probably real estate taxes or property taxes. I don't know in Pennsylvania, do they have an excise tax? In Massachusetts, where I came from, we had an excise tax on cars. So you had to pay an extra tax besides your registration on the fact that you own a car.
I'm not aware of
The
that.
city of Medford taxed you for the privilege of owning a car in their city. So those are kind of things, those are quarterly taxes. Bank accounts. You know, what is the difference between a checking account and a savings account? Do you know?
I guess the emphasis is on your using a checking account, and savings, it's less using and you are earning interest.
Yeah. So a checking account is when you get an ATM card from the bank. That's basically it's a checking account, because you're depositing money with the bank, but but the bank is giving you the privilege of taking money in and out, and a lot of times they will charge you a fee for that convenience. And so that's why. A savings account, you can deposit and withdraw, but usually for savings account, it's meant for you to deposit and then only withdraw occasionally, not the way you would with a checking account where the money goes in and out all the time. With a savings account, you put the money there, and then maybe you take it out when you need to pay a bill or something like that. A money market account is another instrument that the bank uses, and what they do is they deposit your money. It's in an account that bears a little bit more interest, but usually there are some qualifications to that. A savings account, you can usually, I think there are some savings accounts, especially like the junior accounts, you can open with as little as $25. Money market account usually asks you for a couple of $1,000s to deposit. And then again, this is money that you would not be withdrawing all the time, not using as a checking account, but it is a place to deposit money to get a little bit more interest. And let's say you have a large bill, you have an insurance bill that gets due, and so you need to pay that, or whatever. So that's it. Certificates of deposit are another instrument that the bank provides. And what it is you give them a certain amount of money, for example, a $500 certificate of deposit. And what it is they have terms. You can get a 6-month or a year and a half. You can get certificates of deposit in any year. What it is you give them that money and you can't touch it until the certificate matures at the end of the term. So if you have a 6-month CD, you put your money there, you put your $500 in that, and then you have to wait for the 6 months for the CD to mature. And then you can either take the money out or you can reinvest it into another CD. And we've done that we have some CDs. We don't really recommend CDs because it traps your money. You can't access your money and all of a sudden if you need it, we don't recommend it for an emergency saving, which we'll talk about later. The money market account. But these are things that you can get at your local bank. So if you go up to Citadel, up the street there, or there's a new savings and loan that just opened up here, those are the instruments that they have. Writing a check and balancing a checkbook, but we don't need to do that. But you said you were not quite sure about balancing the checkbook, right? I have.
People do it a lot less now.
People do it a lot less, correct.
I actually just got my checks in.
So this was from Dave Ramsey, and here you go, that. And then this was from, I think this was from the Kansas City Fed. This was wonderful. This was a great little thing where you actually, 1, 2, 3, here you go. This is really cool. So, I didn't staple them on purpose so that you can spread out the stuff because it helps to look at various things. So I didn't get my cheat sheet here because, and I'm going to come down here and look at that. So if you look at John, can you follow me here? Good. So if you look at this, let's look at that. So here would be, this would be the register that he has, right? And this would be what you get from the bank. So usually, even if you do electronic banking, you get a bank statement. And then what I do is we do online banking. And what we do is when it comes out at the end of the month or beginning of the month, depending, sometimes it's 29th, 30th, 1st, whatever. I print out my bank statement, then I get my checkbook, and then I see what is cleared, what hasn't. So if you look through here, so this tells you in your how to do it. Basically, it's a worksheet. And in your bank account register plus a check mark between each check paid. So what you do is, if you put these side by side, you notice there's a little check mark here. So, the Lottie-Do's birthday, was that paid? That was what? That was check number 128, that's right here, $20, so that came up, so you'd put a check. And then you go through and, check off each one of those. And when you've got all your checks, what you do is enter any deposit that didn't appear on the statement here. And then you put the ending balance plus the total deposits, not shown on this statement, in here. And then over here, enter items outstanding or withdrawals that have been entered on the bank but do not appear on the statement. So if you look here, there's a couple of these that don't appear on the statement there. So check 129, the debit at C-Stop and auto pay didn't clear. So, and also Safe Gecko was put on 217, didn't get clear. So you would add those in the front, add up the outstanding amount, subtract out the total item outstanding, and then that number, this number here, should equal the balance on your checkbook, on your thing, which is balance right there. So And this is a little thing you can do. There's another one that, I'll just give these and you can play with these at home. And at the end of the presentation is my contact information. So if you have a question, please email me. I would love to go over this with you and helping out. So this is all different exercises on balancing your checkbook. The principles are all the same, but it's just helping. I just want to give you some tools to play with and just kind of go through that. So we have the savings. Saving is, the reason I have Earl here, and I'll explain why my little piggy bank is named Earl. We save for emergency expenses, for variable expenses, and for long-term expenses. It is important to save up for certain things, especially emergencies. And of course, nobody has an emergency, right?
Until you do, I guess. No.
So, savings, emergency. Dave Ramsey, who is a big financial guy, does a whole lot of things. Some of the material is from his course. Suggests putting aside $1,000 as quickly as possible to deal with emergencies. And a long-term goal is to set aside 3 to 6 months living expenses. How do you know what is 3 to 6 months living expenses? Well, that's where your spending plan comes in and tracking your expenses, whatever. So, and 3 to 6 months living expenses will be different for every family. But that really is your long-term goal, because we all know that unemployment happens. My husband was unemployed for 2 years. It was not pretty, but we made it because we had the cushion. We had set aside money. We also lived very frugally, but we had set aside the money so that we could keep going and we didn't have to sell our house or move out, which some people do have to do when they are unemployed. So this is what the emergency savings is for. You get replacement savings is short-term savings to deal with bills that come up quarterly rather than monthly. So you set money aside and you divide the invoice by 3 or by 12, how much money to put aside each month so that the money is there when the bill is due. Transfer the money from savings to checkings to pay the bill. Remember to set aside money for Christmas, birthdays, vacation, because that happens. So let me just show you kind of what I mean by setting aside money here. So we have this, if you look at this sheet here, so you have some examples. So for example, if your real estate taxes is $3,600 per year, it's on this sheet here, you divide the amount by 12 and you know that you need to save $300 a month to pay that bill. And for car maintenance, you're going to estimate how much you're going to spend on car maintenance, and then you put, again, divided by 12, 150, insurance, vacation again, Christmas presents. Christmas does happen. It comes every year. And you may not celebrate Christmas as we try, but there are special occasions. There are birthdays. There are weddings. You need to plan for those. And so you kind of need to set aside money for that, and there's your money. Major furniture, those kind of things. So this is how, to kind of make sure that you use savings for those kind of things. And then long-term savings is savings for items that will, I wasn't quite thinking when I did this presentation, that will be well into the future, such as retirement or children's college funds. I forgot a few words in there. All of a sudden I'm realizing that. Long-term savings, a retirement plan, IRA, college education for the children, those kind of things. Do you have a company, do you have a company's retirement plan?
Mm-hmm.
You do? You do not?
I don't, because I'm only part-time.
You're only part-time? Okay.
403B.
403B, yeah, 50, yeah, 403B. I had a 403B because you're working for a social service agency.
Yeah.
When I was at a church, I had a 403B as well, and then 401Ks, those kind of things. So one of the things that I really, I hope you are putting money aside there, especially later on perhaps when you get into a different job and you are working at a company and they offer matching savings, make sure you take the company match. Put the minimum amount that you need and then to get the match, because they're basically giving you free money. Now
Do you have
granted,
the maximum
Hmm?
amount, maximum amount?
I would give as much as what their maximum amount, yes. So this is a little chart that Dave Ramsey thinks of about Ben and Arthur, about how important it is to save for retirement. And the sooner you start, the better. So as soon as you get a job, Sophia, where you are eligible for a company retirement plan, sign up right away. Even if it's $50 a month, you know, just the bare minimum. But if you look at that, the sooner you start, and even if you have to stop for a while, the money keeps accumulating, and that's what we call, we'll talk about compound interest. Let's see here. Have I overwhelmed you totally right now so far? You're tracking with me? Good. What I'm talking about, cash flow strategies, is to schedule bills to avoid a cash flow crunch. For sometimes, do you get paid once a month, twice a month, or every other week? It makes a difference. How do you get paid?
I get paid twice a month.
Twice a month.
And
So
then
like
occasionally it'll be 3 times a month.
No. Are you paid every other week?
Every other week.
So you'll get 26 paychecks a year, correct? Are you paid every other week or twice a month?
I would say every other week.
Okay, it's different.
I'm not sure, actually.
But
I
because,
haven't thought to ask.
you get paid twice a month, let's say, some companies do on the 15th and the 30th, regardless of what day it is. Other companies, which is every other week,
Mhm.
is on the 2nd and 4th Friday of the month, or
That's more
whatever.
like-
That's, okay, so
That's
what you
what
are
it is.
doing is you're getting paid every other week.
Okay.
What that means is you get 26 paychecks per year. If you were paid twice a month, you would get 24. So as you mentioned, every once in a while, there's this month where you get an extra paycheck, which is really nice. But this is where you need to think about those months where you get that extra paycheck. Think about what you're going to do with that. Don't just let it, have a plan for that money. A friend of mine had a very easy suggestion, because you get an extra paycheck in the spring and an extra paycheck in the fall. And so it depends on which month it falls in, depending on how the weeks work out. Just said, okay, so the spring extra paycheck, that's my summer vacation money. And the fall express paycheck, that's my Christmas money. And she lived on 2 paychecks a month. And so she had that extra paycheck, she knew it went right into the bank, and that was her summer vacation. She knew exactly how much she could spend on summer vacation. She lived alone, so she could do that. But that's a really easy
Mhm.
way to deal with that. Another great way of dealing with that extra paycheck is to put it towards a spending goal. For example, you could take that extra paycheck and do a payment on your student loan, or you could make a prepayment on a car loan, or what, you could pay off some debt, or those kind of things. So This is, what it is sometimes you have some bills that are due at the beginning of the month, and what you want to do is you want to list out your bills so that they're not all hitting at the same time. And a lot of the utility companies and a lot of the places, for example, if you just want to change your billing date, for example, you're noticing that you're getting 5 bills at the beginning of the month but only 2 at the end, you can call up companies and have them change your billing date to a later cycle. They don't care as long as they get their money. And then this way, that keeps you from having the cash flow crunch, where all of a sudden you've got all these bills to pay and not enough cash. So that's what the cash flow strategy is. What's the difference between saving and investing? Saving is for the short term, emergencies, planned future purchases. Think of savings like insurance. Investment is for the long term. Dave Ramsey says investment is wealth building. It's for retirement, for children's college education. You are building up your net worth, as we talked about. So that's the difference between saving versus investing. I do not give investment advice. I won't go into it. There's some wonderful stuff. There's some wonderful handouts on the table. Yeah, the handouts on the table. Feel free to look at and take anything that is of interest to you. So savings account, we talked about bank passbook accounts, certificates of deposit, money market accounts, investment accounts, stocks, bonds, and mutual funds. Do you know what stock, bonds, and mutual funds are? And would you like to know what they are? Just basically. It's just basic financial terms. Stocks are sold by an individual corporation. You own a share of the company. Bonds are floated by corporations, towns, or utilities to make money. You are basically loaning the company money. So that's the difference between stocks and bonds. So when you have stocks, you own a piece of the company. My husband had a paper route growing up, and with that paper route, he bought some stock in Coca-Cola. He owned a part of Coca-Cola. Bonds floated by corporation, or you'll notice that the town needs to raise money. They will float a bond, and what it is people loan the town money and a bond, and then the town pays them interest on that money. And so they get the money back, they get the interest on a regular basis, and when the bond matures, you get the entire money back, plus the interest that you've gotten as you've gone along. Mutual funds are just a group of funds, a group of stocks or bonds managed by a fund manager. So we have Vanguard right here in Malvern. That is a mutual fund company. The fund manager decides where to invest, whether to invest in stocks or in bonds. If the fund manager invests in stock, you have a mutual stock fund. If the fund manager invests in bonds, you have a mutual bond fund. The principles are still the same. Mutual funds are really very useful tools because you're letting Vanguard make all the decisions, or Fidelity, or T. Rowe Price, or Morningstar, or whatever. They're making the decisions on what the companies are, but they are managing your money, and then you get some interest back. So if you want an introduction to mutual funds, go to SEC, the Securities and Exchange Commission.gov. That's on the blue sheet, the website. Okay. That's a great website. Believe it or not, it's nitty-gritty, one step at a time, really how it is. There's some fantastic websites out there.
And why do you say mutual fund?
They're called mutual funds.
Oh.
That's what they're called. They're
Okay.
a group of stocks or bonds managed by a fund manager.
Okay.
So Vanguard, since they're local, that's the primary example. I came from Boston, so we always used Fidelity, but that's, there are lots of different things out there. I'm doing for time, I'm doing well here. Okay, credit reports and credit score. There's a difference between a credit report and a credit score. Here's the, and this is the thing from the SEC. I had made up a printout of it, which you can just go, so it just tells you everything around. So this is the chart, this is the difference between a credit report and a credit score. So the credit report is generated from records of your access to credit and your payment history. It's used by lenders to measure risk, and you are entitled to one free credit report from each agency per year. Now we have this whole big thing with Experian and that horrible mess where the data was compromised and everything else. Now credit freezes. What credit freeze does is it keeps anybody from giving you credit in a sense. So if someone compromises your identity, they can't see your credit report, but they can't do anything. That's what the credit freeze does. Now, credit freezes are now free. And you get one free credit report from each agency per year. So Experian, Transamerica, TransUnion, and whatever. So what we recommend is that every 3 months, you get your free report from another agency. Or every 4 months.
Rotate.
You rotate. You go to one, and then 4 months later, you go to another, and then 4 months later, you go to the other. They will be slightly different, but this way you can monitor your credit report and make sure that there's nothing there that shouldn't be there, because if there are errors on your credit report, you want that corrected. And if there are things that all of a sudden you notice, wait a minute, I didn't take out that loan, you know, this is where kind of a fraud alert, oh my gosh, has my identity been compromised? Which is very easy these days. Everything is accessible on the web. I'm so glad that Medicare finally has removed the Social Security number from Medicare cards. I mean, hello. That was one of those. So your credit score is what lenders use to evaluate how much of a risk you are. And it affects the interest rate agencies will offer you, and can also affect other areas such as employment or landlord. And I have this sheet on here, but I gave you the printout because it's a lot easier on how your score is calculated. So your length of credit history is 15%. The types of credit is 10%. Credit inquiries, how many times you ask, for credit. Your payment history is really important, and the total owed. These are the big numbers that affect your credit score. So this is what makes up your credit score. August 2014, so you can see when I printed this out. So,
Do you mind if I ask a question about that?
please.
My understanding is that this kind of thing gives you incentive to have credit action going on and use it a lot?
Not necessarily, no. It doesn't do that. That just tells the potential lender how much of a risk or not risk you are. The higher the credit score, the more apt they are to loan you money at a much better rate. And I have a chart here somewhere, or maybe I didn't print it out, on different scenarios what it is. So, here, it's right up here. So if you go credit score, if you have a credit score in the high, this is the high range, usually they will offer you a good rate at 3.45%, and so your monthly payment, so let's talk at an auto loan of $15,000, which is not an unreasonable, at 48 months. So if you have a very good credit score, they offer you a good rate, which means you're paying $335 per month. If you are at the lower end, just look at how the interest rates jump. if you have a poor credit score, you're paying 15% interest, which means that instead of paying $335 a month, you're paying $423 a month for the very same car. But this is where your credit score is important. It affects what interest rate lenders will give you. So, you know, that's a lot of money. That's a chunk of change. You know, you can use the extra, which is why we say, you know, make sure, you know, get your credit score. I think Discover Card publishes their credit score on their statement if you have a Discover Card, which is really nice. That's kind of cool. What things affect your credit report? That you pay in full and on time. Late payments are bad, 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 bad. Debt versus available credit ratio, and I'll talk to you about that. Credit management history. Have you been able to get a loan, pay it back in full, pay a loan, pay it back? The mix of the types of loan and the recent activities. So good strategic moves, all right? On-time payment history. Pay your bills on time. Paying loans off entirely or paying them down is a good thing. A consistent low balance versus your credit limit. Having some available credit and batching inquiries when shopping for a mortgage or a loan. And that means, you know, you don't do it today and then 3 weeks later you inquire again. So if you inquire, you know, different agencies, yeah, today, tomorrow, the next day, that's called batching those inquiries. What you don't want to do is ask today, then 3 weeks later, ask another agency for that loan, and then 3 weeks later again. So you want to make sure you batch them. Bad strategic moves, and that's all in your slide deck. Late payment on mortgages, national credit cards, or car loans. Recent delinquencies, frequent credit inquiries, collections, defaults, judgments, foreclosures, bankruptcy, income tax liens. Yeah. Those are really, okay, yes.
Frequent credit inquiries, would that mean your own or just
No,
companies?
for example, if you keep inquiring for a loan for a certain thing and you do a lot of those,
Okay.
where there's a lot of hits on your credit report, someone says, what's going on here? And they don't like that. That will cause your score to go down. So bad strategic, one that is very important, closing the cards without thought of loan to credit availability ratio. And what this is this is what they look at. There is a ratio of your credit limit, so this is how much MasterCard is. You've got a $10,000 limit on that MasterCard, a $5,000 on the Visa, a $20,000 on the Discovery. You have a second MasterCard with a $7,000 limit. So your credit limit in total is $42,000. The amount you owe, on this MasterCard you owe $5,000. On this Visa you owe $2,000. On this Discover card you only owe $1,000, and on this MasterCard you owe $6,000. So you have $14,000 owed against $42,000 in credit. This is your credit availability ratio, the ratio of this. This is a relatively small number. You owe $14,000 on available, $42,000, or about 33%. But let's say you decide, oh, I'm going to get rid of this Discover card, and if you close the Discover card, that's not the good one to close, you know, because now you owe $13,000. Your available credit is only $22,000, and you owe $13,000, just about you more than half towards your credit. You're using more of the available credit, which is not a good thing. So if you're going to close a card, that's my junk call, my 8 o'clock junk call. We're going to let that go to voicemail. I get I get a 6 p.m. jug call. I get a noontime jug call. Do you know my
Junk
phone?
call?
A jug call, you know, somebody trying to sell me a credit card or whatever. Oh, yeah. So we're just gonna let it go. That's what voicemail's for. So this is what on credit score. So compound interest is another term that you will learn, and what it is that interest, compound interest is interest earning interest. And if you look at Ben and Arthur, that was that chart that you gave. Both Ben and Arthur save $2,000 per year. Oh, I forgot a zero there. About $167 a month. Ben starts at age 19 and stops at age 27, while Arthur starts at age and stops at age 65. So if you look on the chart that I gave you with Ben and Arthur there, you see that even though Ben has stopped for a while, or is it Arthur? Yeah. Ben has stopped for a while. He still has, he did the 2,000 at the beginning, but because of compound interest, he has over $2 million. Whereas Arthur, he started later and he kept it up, but he has much less. So this is why we say with compound interest and with the retirement plans, the earlier you start, the absolutely better it is. So compound interest is a little chart. So let's say you've got.
And where would that be? Like, that would be on not a savings.
Usually retirement plans, you usually would put it in like a mutual fund, a bond fund, a stock fund. You want to diversify your portfolio, and your fund manager will tell you that.
Okay.
Well, you know, depending on what kind of a risk, how much risk you want to take. You know, I really recommend Vanguard for customer service is really wonderful. They are very good. They will walk you through. They offer free seminars to explain everything. They are really very much into customer service. Yeah, they all do, but they're right here. They're local. I really would investigate them and do that because they really are very good. So compound interest works, you know, time is in your favor. So you have this amount of money that you've put in, and this is the compound interest. In 10 years, 15 years, 20, it keeps growing. So, and this would be long-term, so this would be a retirement account. So you notice you're not putting in that much, but the interest, the compound interest builds up monumentally as it goes along. So, any other question on that before I go into a 4-letter word? So we have debt, and in this day and age, it is very hard to be without debt. Dave Ramsey is absolutely adamant that you have absolutely no debt liability. I think that's, you know, he does not use a credit card, he uses a debit card, he does everything in cash. For me, that is hard. I think you need to be a little wise. Use the tools. Basically, you can use credit, but you have to be responsible. Okay, debt is debt on an asset that will appreciate. You're not going to plunk down $400,000 in cash to buy a house. But, so you have to have a mortgage to buy a house. So, okay, debt is debt on an asset that will probably increase in value. All right? A house usually increases in value. A business, if you invest in your business, usually it's to grow your business so that helps. Education to a point. You have a student loan, so you get an education so you can get a better job. But again, we need to be very sure that you don't have too much student loan debt that you're not going to be able to repay. Bad debt is debt on a consumable that will decrease in value. Credit cards, card loans. And I encourage you to reduce your debt liability as quickly as possible. We like to say if you're not paying your credit cards off in full every month, you're carrying too much debt. You know, we use a credit card, we have credit cards, we pay the balance off in full every month. But, you know, it's, you know, how are you gonna make a plane reservation? How are you gonna rent a car? How you know, all those things. The only thing I ask you to be very careful of is, you know, when you're on the internet, it is really easy to click, click, click. And as Amazon, you know, you have bought $300 worth of stuff in 30 seconds by clicking on it. So just be very, very careful when you're shopping on the internet. It's wonderful. I love Amazon. I do a ton of stuff on there, but just be very careful that you keep track of the amounts that you use on there. So debt repayment scenarios, again, paying debt off early. I don't think I need to go that, okay. Debt reduction schedule, that's called a snowball, but I don't know if you want to go into that or not. I don't know. I'd gladly do that. Oh, here it is. You know, that's not very, yeah. Anyway, here's my info. skipcat@comcast.net. So if you have any questions, please email me. And do you have any questions for me now? You know, I had blocked the town until 8:30 because I didn't know how many times, but you know, we're free to leave whenever you're done. If you have any questions you'd like to ask me, please check out the handouts that I have, and you know, let me know. Thank you for coming.